Hello, my name is Eli Smart, and my topic is to what extent and under what conditions and circumstances must auto dealerships report their reserve on indirect consumer auto financing as income for tax purposes. The first question is, what is the primary issue in this case? As with many tax accounting issues, one of the issues has to do with timing, or when should reserve payments be reported as income, and the other issue has to do with contingent income from sales contracts. So, for example, SAB 104, 48C states that contingent income should be accrued when the changes on which the contingent payments are based actually occur. So what is reserve? There's a lot of different definitions for reserve. For our purposes, we'll define reserve as the portion of income due and payable to an automotive dealership from a consumer auto finance contract that is not constructively received on the day that the vehicle is sold. I did include a handout for my presentation discussing the automotive, the process of finance process for consumer auto sales contracts. And what you'll notice, of course, first on that handout is there's two types of loans. Essentially, there's prime loans and subprime loans, and the sheet goes into more detail about the timing of the payments on those. But essentially, just to summarize the handout, on a prime loan, the reserve is received within a few days. However, it's contingent. So if the customer doesn't make 3 to 6 payments, then the dealership is subject to a chargeback on that reserve amount. However, it is actually received within a few days of the sale. In regards to subprime loans, the reserve is generally not received on the date that of sale. It's generally received over time, and it's received as a percentage of each monthly payment over the entire term of the loan, which can be as long now as 6 or 7 years, although it's generally 5 years or 4 years. So in regards to the questions of timing, or the timing of the income, generally speaking, on prime auto loans, the reserve amount should be reported as income on the date in which the vehicle is sold. The reason is that in the case of prime auto loans, the all events test is satisfied in regards to the receipt of the reserve, as we said, on the date when, within a few days of when the sales contract does take place, or day 0, as I should say on my handout. So, going through them, the payment is earned. Well, it's not really earned in the sense, but it is received, and it is due and payable to the taxpayer on the date of the sale. So it does satisfy that test. Of course, the issue is, has it been earned yet? However, that is something that you can account for with a bad debt reserve in the following tax year, if indeed the amount is charged back. The most famous case in regards to dealer reserves is Commissioner versus Hansen, which is actually mentioned in the textbook. According to this case, the dealer reserve should be included as income in the year of the sale. In PNC Bank Corporation, there's a case, PNC Bank versus the Commissioner of Internal Revenue in the Third Circuit, which actually overturned the IRS ruling stating that some of the payments that banks make to dealerships should be capitalized. The Third Circuit actually said that the reserve payments that are paid to dealerships actually are considered expenses and can be expensed in the current tax year as ordinary and necessary expenses for banks. So that also indicates, my original point that those should be included as income when received, and actually in the year of when the sale actually takes place in regards to prime loans. On subprime loans, it's a different story. In that case, the reserve amount should be reported when actually received, regardless of whether or not it's an accrual or a cash basis taxpayer. And the reason for that is that the all events test in regards to subprime auto loans in regards to reserve payments actually has not been satisfied when the sale takes place. There could be an argument, and obviously that would be the most obvious argument against the subprime auto loan reserves being reported as income when actually received. Someone could argue, for example, the Commissioner versus Hansen case. But what I would say is that this is a different situation. In the case of the Commissioner versus Hansen case, the reserves were not clearly separated from the rest of the income that was received from the sale. In this case, especially in the case of subprime auto loans, the reserve amount is clearly separated from what's called the advance or the money that's received up front, and it's clearly stated in the subprime auto finance companies programs that the amount of the actual reserve payments that are going to be received on subprime loans are highly contingent, and they're based on customers' payments in the future. So they're certainly not earned when the sale takes place. Another case to support that would be with subprime auto loans being different is Burnett versus Logan. The Supreme Court disallowed the treatment of the interest portion of future payments from a contingent sales contract as income in the current tax year because the amount of the future payments cannot be determined at the time of sale, which is exactly the case here. The reserve payments on subprime auto loans, it's not possible to determine that on the date when the sale takes place. Subprime auto loans are inherently risky. Unlike prime loans, dealerships that engage in subprime auto financing generally think of the payments they receive other than the advance payment, which generally only covers the cost of the car itself. They generally think of them kind of like a portfolio where some of the loans will perform, some of them won't, and they pay based on what's actually received and based on the performance of the loans, which can't be determined on the date of sale. There's also another issue. There's a lot of different finance companies and banks, auto finance companies. They all have different policies. There's also a lot of variation in the profile of the customer and the structure of the loan when it comes in. You could say that there are some consumer auto finance contracts that don't fit clearly into either one of those categories of prime or subprime, and those are generally called near prime loans. In the case of near prime loans, basically it would be the dealership would need to look at each individual case when it comes to near prime and determine whether or not those are more like subprime or more like prime, and then they should report the income from the reserve payments accordingly based on whichever one it more clearly resembles. Thank you very much. That will conclude my presentation. Thank you very much for listening.